There is a list that the Federal Deposit Insurance Corporation maintains in strict confidentiality. It is called the Problem Bank List. It is updated quarterly based on the FDIC's ongoing examination of every insured institution in the United States, and it contains the names of every bank that FDIC examiners have determined is experiencing financial, operational, or managerial weaknesses severe enough to place its continued viability in question. The FDIC does not publish this list. It does not release it under the Freedom of Information Act. It does not share it with the press. It does not confirm or deny the presence of any specific institution on it. The reason for this confidentiality policy was stated explicitly in a research note published by Dunham Associates. Naming individual banks on the list would likely spark anxiety and create panic, inciting the very thing the FDIC is trying to prevent. The FDIC keeps its problem bank list secret because the knowledge that a specific bank is on it would trigger the bank run that would make the problem bank's failure inevitable. This is the foundational paradox of bank regulation. The information most relevant to depositors' decisions is the information most carefully withheld from them. And this paradox sits at the center of the specific fear that grips regional banks this Sunday as they prepare for Monday's opening bell. Not because Monday morning will necessarily produce a bank failure, but because Monday morning is the first opportunity for the markets, the depositors, the institutional counterparties, and the rating agencies to price in everything that has accumulated since the FDIC published its 2026 risk review just days ago, since the Q1 2026 earnings season documented the specific credit deterioration this channel has analyzed across multiple scripts, and since the 5 simultaneous crises this channel's Sunday emergency video described as converging at this specific moment began making visible what the confidential problem bank list has been tracking for months. The FDIC blackout is not a metaphor. It is the formal, legally grounded, specifically designed information barrier between what regulators know about regional bank health and what depositors, investors, and counterparties are permitted to know. And tomorrow morning, every market participant in the United States will be pricing regional bank stocks and regional bank bonds and regional bank counterparty credit limits with exactly the data that the FDIC's blackout allows them to have: the published aggregate statistics, the quarterly profiles, the risk reviews, and the specific bank failures that the FDIC announces on Friday nights. After markets close, when no press conference is scheduled and no analyst is standing by to translate what just happened into Monday morning's price, let us start with what the FDIC's most recent publications actually say, because the FDIC's own words in its 2026 risk review, published in the final week of April, are the most comprehensive and most authoritative assessment of where the regional banking system stands as of this Sunday. The FDIC's 2026 risk review, which covers the banking system's condition through December 31st of 2025, documented 4 specific vulnerabilities that each deserve precise translation from regulatory language into plain English. The first vulnerability is unrealized losses on securities. Industry-wide unrealized losses on securities portfolios fell 36% during 2025 to $306.1 billion, the lowest level since the first quarter of 2022. This sounds like progress. It is progress. But $306 billion in unrealized losses on a banking system that has total assets of approximately $23 trillion represents a balance sheet liability that exists in every interest rate environment above the levels at which those securities were purchased. The Federal Reserve has maintained its federal funds rate at 3.50 to 3.75% following the April 29th meeting. At those rates, the securities portfolios purchased at the zero interest rate era's peak continue to carry unrealized losses that would materialize as realized losses if the banks needed to sell those securities to meet deposit outflows. Silicon Valley Bank sold $21 billion of its securities portfolio at a roughly 10% discount in March of 2023, when depositor outflows required immediate liquidity. The $306 billion system-wide unrealized loss figure is not theoretical. It is the specific dollar amount that the banking industry would lose if it were forced to sell its securities portfolios at current market prices, rather than hold them to maturity. The question that Monday morning's market will re-examine is not whether those losses are theoretical. It is whether the specific combination of geopolitical risk, interest rate uncertainty, and credit cycle deterioration documented in this channel's recent scripts has increased the probability that specific regional banks will face deposit outflows significant enough to convert some portion of those theoretical losses into realized ones. The second vulnerability documented in the FDIC's 2026 risk review is commercial real estate loan concentration among mid-sized banks. The CRE, past due, and non-accrual ratio, which is the percentage of commercial real estate loans where the borrower is either behind on payments or has stopped paying entirely, ticked up to 1.45% system-wide by the end of 2025. That headline number sounds manageable. The distribution beneath it does not. For the largest banks, those with assets above $250 billion, the non-owner-occupied CRE PD&A rate was 4.06% in the fourth quarter of 2025. That is 4% of the non-owner-occupied commercial real estate loan portfolios of the largest banks in the United States already in past due or non-accrual status. This compares to a pre-pandemic average of 0.58%. The delinquency rate on these loans is 7 times its pre-pandemic average. And the FDIC's own language in the risk review acknowledged that high operating costs, elevated interest rates, and elevated vacancy rates challenged some borrowers' ability to refinance and repay CRE debt, and that banks used loan modifications to provide relief to CRE borrowers. Loan modifications used to keep delinquency ratios artificially lower. That phrase, which appears in the FDIC's own published risk review, is the regulatory acknowledgement of the latent distress concept that Wharton researchers documented as being approximately 4 times larger than current delinquency statistics imply. The loan modifications are preventing the maturity wall from converting latent distress into reported delinquency on the schedule that the underlying financial reality of the borrowers would otherwise require. They are extending the runway. They are not eliminating the cliff. For mid-sized banks, institutions with assets between $1 billion and $100 billion, median CRE loan concentrations are hovering around 300% of Tier 1 capital and reserves. 300%. The regulatory threshold above which bank examiners formally classify an institution as CRE concentrated, and therefore subject to enhanced supervisory scrutiny, is 300%. The median mid-sized bank in the United States is sitting precisely at the threshold that triggers enhanced regulatory concern, not below it. At it. And the $1.5 trillion CRE debt maturity wall arriving in 2026 is the mechanism that will begin converting the loan modifications that are keeping those concentrations from triggering formal delinquency classifications into the formal delinquencies that eliminate the space between the median mid-sized bank and regulatory intervention. The third vulnerability is the NDFI indirect liquidity risk that the FDIC's 2026 risk review described in language that is the most alarming contained in any paragraph of the document. NDFI stands for Non-depository Financial Institution, which is the FDIC's term for the private credit funds, business development companies, hedge funds, and other non-bank financial entities to which the banking system has extended credit at an accelerating pace since the global financial crisis. The FDIC's 2026 risk review stated explicitly, if an economic downturn strikes, NDFIs facing margin calls could collectively draw down their bank-funded credit lines, triggering a sudden and massive liquidity drain on banks. Sudden. Massive. Liquidity drain. Those words appear in the FDIC's own formal risk assessment document published this week. The mechanism is the one this channel documented in the Monday warning video. When the private credit funds, facing the $20.8 billion in Q1 redemption requests, cannot sell their liquid loan assets fast enough to meet investor withdrawal demands, they draw on the revolving credit facilities that banks have extended to them. The banks, whose credit lines to NDFIs are the fastest growing loan category in the entire banking system since the global financial crisis, face the sudden draw on those facilities precisely when their other credit portfolios, the CRE loans, the energy loans, the small business loans, are simultaneously showing the stress documented in this channel's research. The simultaneous multi-portfolio credit stress, combined with the sudden massive NDFI credit line draw that a redemption crisis produces, is the specific liquidity crisis scenario the FDIC is formally warning about in its most recent published document. This is not this channel's analysis of systemic risk. It is the FDIC's own language, published 4 days ago, describing the specific mechanism by which the private credit redemption crisis becomes a regional bank liquidity crisis. Check. Verified. Undeniable. The fourth vulnerability is the one that most directly connects to Monday morning's opening bell fear among regional bank management teams. The FDIC closes banks on Friday nights. This is not accidental. It is policy. The FDIC specifically times bank resolutions to occur after the close of business on Friday so that the institution's customers have the weekend to receive communication from the FDIC about the transition of their accounts, so that the assuming institution has the weekend to prepare for Monday morning's operations, and so that the financial press has the weekend to cover the resolution before Monday's market open without the additional volatility of same-day announcement and market reaction. The two bank failures of 2026 both occurred on Friday nights. Metropolitan Capital Bank and Trust was closed on Friday, January 30th by the Illinois Department of Financial and Professional Regulation. The FDIC page for the bank explicitly states, "No advance notice is given to the public when a financial institution is closed. No advance notice. The problem bank list is confidential. No advance notice of closures is given. The Friday night timing is standard." And the regional bank management teams that are on FDIC examination watch lists that have received informal supervisory guidance about their capital adequacy, their CRE concentrations, or their NDFI credit line exposure spent this weekend knowing something that their depositors, investors, and counterparties do not know: whether the FDIC's examiners have determined that their institution's condition has deteriorated enough to warrant the specific Friday night call that ends with a closure notice and a handoff to the FDIC as receiver. This is the FDIC blackout, the information gap between what the regulator knows and what the market is allowed to know. And Monday morning is the moment at which that gap closes on whatever terms the market, not the regulator, determines. Check, verified, undeniable. Let us now apply this framework to 3 historical moments when the specific combination of a confidential problem bank list, a published aggregate risk warning, a Friday night closure, and a Monday opening bell produced the market dynamics that the current data suggests are structurally available for this Monday. The first historical parallel is the weekend of March 8th through 10th of 2023. This is the most recent and most precise precedent because it describes a Friday night closure, a weekend of information blackout, and a Monday opening bell that produced the most significant regional bank market disruption since the 2008 financial crisis. On Thursday of March 8th of 2023, Silicon Valley Bank announced it was attempting to raise capital to offset losses from the sale of securities it had been forced to liquidate to meet deposit outflows. By Friday, March 10th, the California Department of Financial Protection and Innovation had closed the bank and appointed the FDIC as receiver, the same language and same process used in the January 30th of 2026 Metropolitan Capital Bank closure. The FDIC issued a press release at approximately 4:40 p.m. on Friday, March 10th. U.S. markets were already closed. Asian markets would open that Sunday evening. European markets would open Monday morning. And American markets would open Monday morning to a banking system where the second largest bank failure in U.S. history had just occurred on a Friday afternoon. The Monday, March 13th market open for regional banks was catastrophic. The KBW Bank Index fell more than 25% in the 2 weeks following the SVB closure. Signature Bank failed the same weekend as SVB. First Republic survived until May 1st, before JP Morgan's acquisition resolved its situation. The specific mechanism that made the Monday, March 13th opening so severe was the information structure of the Friday closure. By the time markets could price the SVB failure, it had already been resolved in a way that answered some questions but raised new ones. Which other banks had similar unrealized security loss profiles? Which other banks had concentrated depositor bases with large uninsured deposits above the $250,000 FDIC limit? Which other banks were on the problem bank list? The market could not answer any of those questions with certainty, because the FDIC's confidential list remained confidential, and the bank's individual profiles could only be estimated from their quarterly call report data. The selling that followed the SVB closure was not panic. It was the rational response to the FDIC blackout. In the absence of information about which specific institutions were most exposed to the same vulnerabilities that killed SVB, the market priced every institution with similar characteristics, as if it might be next. The 2026 regional banking system shares enough of the structural characteristics of the March 2023 banking system: unrealized securities losses, CRE concentration, NDFI exposure, Friday night closure precedent already set in January, to make the Monday opening bell following any weekend crisis a specific, documentable risk that the market will be managing tomorrow morning. Check, verified, undeniable. The second historical parallel is the weekend of July 11th through 14th of 2008, the weekend of IndyMac Bank's failure. This parallel is important because IndyMac was the largest bank failure since the savings and loan crisis, and because its Friday, July 11th closure produced a Monday, July 14th opening bell that revealed the specific mechanism by which uninsured depositors respond to a bank failure when they cannot determine whether their own institution is next. IndyMac had $32 billion in assets at the time of its closure. The FDIC had approximately $45 billion in its deposit insurance fund. The closure of a $32 billion bank was not in itself a death-threatening event, but the IndyMac closure revealed something that transformed it from an isolated event into a systemic signal. More than 10,000 depositors had balances above the FDIC insurance limit of $100,000 that existed at the time. Those depositors who discovered over the weekend of July 12th and 13th that a portion of their deposits would not be immediately accessible lined up outside IndyMac branches on Monday, July 14th. In scenes that the financial press broadcast nationally. The photographs of the IndyMac line, Americans standing outside a bank waiting to access deposits that they were uncertain about, were the specific image that crystallized the public's understanding that bank failure was not an abstract regulatory event, but a concrete depositor experience. The current FDIC insurance limit of $250,000, unchanged since 2010, was flagged by the ABA Banking Journal in January of 2026 as a specific systemic risk precisely because the deposit insurance cap has not kept pace with inflation or with the size of the accounts that small businesses, payroll processors, and professional service firms routinely hold at regional and community banks. The October 2025 scare that sent some regional bank shares plummeting, referenced in the ABA Banking Journal's top risks for 2026, was driven in part by this same uninsured deposit concern. At every market stress event since the SVB failure, the market has demonstrated that it has permanently internalized the lesson that uninsured depositors are the mechanism that converts a solvency problem into a liquidity crisis. And regional bank management teams know that tomorrow morning's market open is the next opportunity for the market to retest that lesson. Check. Verified. Undeniable. The third historical parallel is the period of 2010 through 2013, when the FDIC resolved more than 400 banks using the same Friday night closure, no advance notice, weekend resolution process that it used for Metropolitan Capital Bank and Trust on January 30th of 2026. The specific dynamic of that period that is most relevant to the current environment is the relationship between the FDIC's problem bank list size and the market's ability to anticipate which specific institutions would be closed on any given Friday. The FDIC problem bank list peaked at approximately 890 institutions in late 2010. During the period when the list was at its peak, regional bank stocks exhibited what financial analysts called the Friday afternoon effect, a systematic tendency for regional bank stocks to sell off in the final hours of Friday trading, as investors priced in the possibility that the specific bank they held might be the one receiving the Friday night call from the FDIC. The Friday afternoon effect was the market's rational response to the FDIC blackout. Unable to know which specific institutions were on the confidential list, investors priced the uncertainty by reducing exposure to all institutions with similar risk profiles before the Friday closure window opened. In 2026, the FDIC problem bank list is not at 890, but the specific CRE concentration data that the FDIC's own risk review has now published, the 300% of Tier 1 capital median for mid-sized banks, the 1.45% PD&A ratio, the 4.06% PD&A at the largest institutions, and the acknowledgement that loan modifications are keeping delinquency ratios artificially lower, is the analytical basis for a new version of the Friday afternoon effect, beginning to operate in regional bank stocks. Not because the list is as long as in 2010, because the information asymmetry between what the regulator knows and what the market is allowed to know is as large in the specific areas of CRE, latent distress, and NDFI, indirect liquidity risk, as it has been at any point since the 2023 regional bank crisis. Now let us be precise about the 4 specific data points that regional bank management teams are watching as the most likely Monday morning price signals for their institution's relative vulnerability. The first is the KRE ETF opening level. The SPDR S&P Regional Banking ETF, which we documented as having fallen 5% in a single session on March 2nd of 2026 in the liquidity blackout script, is the market's primary real-time instrument for pricing aggregate regional bank credit quality. Monday morning's KRE opening level will signal whether the market's weekend assessment of the 5 crisis convergence this channel has documented has produced incremental selling pressure in the regional bank sector. Any KRE opening decline of more than 2% should be interpreted as the market beginning to price in the specific regional bank vulnerabilities the FDIC's risk review documented. Any decline of more than 5% should be interpreted as the beginning of the information-seeking selling that preceded the March 2023 crisis. The second data point is credit default swap spreads on specific regional bank names. The CDS market, which prices the insurance cost against a specific institution's default, is the most sensitive real-time indicator of whether sophisticated counterparties are reducing their exposure to specific regional bank names. A CDS spread widening of more than 50 basis points on any single significant regional bank name on Monday morning is the specific signal that the counterparty credit limit reduction mechanism, this channel documented in the liquidity blackout script, has entered its acceleration phase. The third data point is the overnight funding rate differential for regional banks. The difference between the rate regional banks pay for overnight interbank funding and the federal funds rate is the most precise measure of whether Wall Street's interbank lending desks have begun the counterparty credit limit reductions that precede the visible liquidity stress that eventually forces a bank to the federal home loan bank advance window or the Fed discount window. Any overnight rate differential expansion of more than 25 basis points for the regional bank sector as a whole is the early liquidity blackout signal. The fourth data point is the FDIC's Friday night closure calendar. If the next Friday night brings a bank closure announcement of an institution with more than $2 billion in assets, the 2023 playbook executes automatically. The market will spend the following Monday morning selling every regional bank with similar characteristics, unable to determine from publicly available information which of them might be next on the confidential list that the FDIC keeps specifically, because publishing it would trigger the very outcome it is trying to prevent. Subscribe now, because in the next 48 hours we are releasing the complete analysis of the $306 billion in industry-wide unrealized securities losses, state by state, including which states have the highest concentration of regional banks, with CRE loan-to-capital ratios above the 300% threshold that regulators identify as excessive risk, which specific metropolitan markets have the highest combination of office vacancy rates and regional bank CRE concentration that creates the most acute maturity wall pressure, and the specific NDFI credit line exposure data by bank size that quantifies the potential magnitude of the sudden massive liquidity drain the FDIC's own risk review has formally warned about. Regional banks are terrified of Monday's opening bell, not because they know something the market does not. It is because the FDIC blackout means the market cannot know what the examiners know. And the specific data the FDIC has chosen to publish, the $306 billion in unrealized losses, the 1.45% CRE PDNA, the 300% median CRE concentration, the NDFI liquidity drain warning, the artificial delinquency suppression through loan modifications, is the data that the FDIC is permitted to publish precisely because it does not identify specific institutions. The institutions that are on the confidential list know they're on it. Their management team spent this weekend doing exactly what the FDIC designed its Friday night closure process to allow, preparing for the possibility that this Monday is the Monday their institution discovers that the blackout has ended. There's a specific dimension of the FDIC blackout that demands deeper examination because it connects the regulatory information gap directly to the FDIC's own acknowledged institutional readiness problem. In a report published by the FDIC's Office of Inspector General, the OIG formally evaluated the FDIC's readiness to resolve large regional banks in the period prior to the spring 2023 failures. The OIG's conclusion was stated with the specific, understated precision of government audit language. The FDIC's readiness to resolve large regional bank failures under the Federal Deposit Insurance Act was not sufficiently mature to facilitate consistently efficient response efforts in a potential crisis failure environment. Not sufficiently mature. The FDIC's own Inspector General determined that the agency responsible for resolving bank failures was not adequately prepared to resolve the category of bank failures, the large regional bank failure, that the spring 2023 crisis demonstrated was the most consequential type. The OIG found that the FDIC had not ensured it fully met its human and technology resource needs and had not sufficiently coordinated resources among its divisions and offices. The report made 11 specific recommendations to address these findings. The FDIC has been implementing those recommendations since the spring of 2023. But the specific question that the OIG's finding raises for Monday's market is not whether the FDIC has fully implemented all 11 recommendations in the 26 months since the report was issued. It is whether the FDIC's improved but still maturing resolution readiness is adequate for the specific resolution scenario that the $1.5 trillion CRE maturity wall and the NDFI liquidity drain risk could require in 2026. The OIG's finding was about the FDIC's readiness before the SVB crisis. The SVB crisis involved 3 banks with aggregate assets of approximately $500 billion resolved in approximately 2 months. The scenario the FDIC's own 2026 risk review describes, where multiple mid-sized banks with CRE concentrations near the 300% threshold simultaneously face maturity, wall-driven delinquency increases, compounded by sudden NDFI credit line draws during a margin call environment, could involve more institutions simultaneously than the spring 2023 crisis, while the FDIC's resolution machinery, though improved, is still completing its post-OIG finding remediation. This is not a prediction that the FDIC will be unable to manage the next regional bank crisis. The FDIC has managed every crisis it has faced since its establishment in 1933 without a single insured depositor losing a penny. What it is a specific, documented, publicly available assessment that the FDIC's resolution readiness was found inadequate for large regional bank failures in the period immediately before the crisis that tested it most severely, and that the structural vulnerabilities documented in its most recent risk review have not resolved in the intervening period. The Deposit Insurance Fund balance provides the final quantitative context for the FDIC blackout stakes. At December 31st of 2025, the DIF balance was $153.9 billion. The reserve ratio, which measures the DIF balance as a percentage of total insured deposits, was 1.42%. This means the FDIC has $1.42 in its insurance fund for every $100 of insured deposits in the system. The reserve ratio is within the statutory requirement of 1.35% mandated by the Dodd-Frank Act. But at 1.42%, it provides a limited buffer against a scenario involving multiple simultaneous regional bank failures that each require material DIF expenditure. The Metropolitan Capital Bank Trust failure cost the DIF $19.7 million against $261 million in assets, a 7.5% loss ratio. If a significantly larger regional bank with substantially more assets and a higher proportion of uninsured deposits required FDIC resolution, the DIF loss ratio could be materially higher. The FDIC's ability to maintain depositor confidence through any regional bank resolution depends entirely on the public's understanding that the DIF is adequate to cover their insured deposits, and that the FDIC's resolution process will protect those deposits regardless of which institution fails. That understanding is the specific institutional asset the FDIC blackout is designed to protect by withholding the information that would test it. The problem bank list stays confidential because the knowledge of which banks are on it would create the depositor behavior that the DIF would then need to manage. Monday morning's market open is the specific moment at which the accumulated data from this channel's research, from the FDIC's own risk review, from the Q1 bank earnings filings, and from the 5 crisis convergence documented in the Sunday emergency script will interact with the market's uncertainty about what the confidential problem bank list contains. The regional banks that are most exposed to that interaction are not the banks whose balance sheets are strongest. They are the banks whose balance sheets look most similar to the institutions that the FDIC's published data describes as approaching the thresholds that trigger enhanced supervisory concern. Tomorrow's opening bell is where that similarity gets priced, in a market that knows what the FDIC has published and cannot know what the FDIC has withheld. There's a final practical dimension to the FDIC blackout that this video must address directly, because it is the dimension that matters most to the people watching this video who have money in a regional bank and want to know what to actually do with this information. The FDIC's $250,000 insurance limit has been unchanged since 2010. It covers the deposits of approximately 98% of all American depositors, meaning that the vast majority of individual depositors in any regional bank are fully protected, regardless of what happens to that bank's equity, regardless of what is on the confidential problem bank list, and regardless of what Monday morning's KRE ETF price does. If a bank fails, those deposits transfer to the assuming institution on the schedule the FDIC arranges over the resolution weekend, with customers typically able to access their funds by Monday morning at the assuming institution's branches and through continued use of the failed bank's ATM and debit cards. This is not theoretical. It is what happened to Metropolitan Capital Bank and Trust's customers on January 30th. First Independence Bank assumed substantially all deposit accounts. Customers could continue using their checks and ATM cards. Direct deposits continued as usual. The system worked exactly as designed. The FDIC's record of protecting insured deposits is perfect. No depositor has lost a single penny of FDIC-insured funds since 1933. That is 92 consecutive years of protecting the insured deposits of people at every failed bank across every recession, every financial crisis, every geopolitical shock. The FDIC blackout is not a threat to insured depositors. It is a threat to uninsured depositors, to equity investors in regional bank stocks, to counterparties who hold regional bank debt, and to the businesses that hold account balances above the $250,000 limit as working capital. For those stakeholders, the confidential problem bank list is genuinely relevant information that the regulatory architecture withholds from them because the withholding serves the systemic stability that makes the information irrelevant for the vast majority of individual depositors. Understanding this distinction is essential to calibrating the risk this video describes. The regional banks are terrified of Monday's opening bell not because they are about to fail. Most of them are not. They are terrified because the market does not know which ones might be approaching the thresholds that the FDIC examines in confidence, and uncertainty in an environment of 5 simultaneous crises produces selling pressure that is not proportional to the underlying fundamental deterioration. The selling pressure is proportional to the information gap. And the information gap, by institutional design and by statutory authority, is maintained by an agency that will never tell you in advance which Friday night it is coming. Subscribe now. The bell rings in less than 18 hours.